All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. How's Los Angeles?
Los Angeles is great. I know you were recently out in California as well.
Yes, I was at the Future Proof conference. Maybe we can chat about that a little bit later. But on the beach in Huntington Beach, it was a great experience.
Yeah, I'm sure it was beautiful down there. Well, we have a lot of questions this week to get to, so let's jump right into it. First up, we're at the end of September, so what's moving stocks as September comes to an end?
Well, the most important thing is the job market. And so far, the job market is slowing down a bit, but still strong. And that's the key. The Federal Reserve wanted the job market to slow down. The problem is aggressively raising interest rates the way they have traditionally creates a recession. That has not happened, which is somewhat improbable. And that's where you get this soft landing idea, which is that the economy slows down, but not so much to cause a recession. Very tricky to pull that off. But so far, it's working. So if you ask me what matters for stocks in the fourth quarter, definitely the jobs market. How far is the drawdown in the job market going to go? After that, I would say, how much is the Fed going to cut rates? We got some inflation data today that was really good. The Fed's preferred inflation gauge is called the personal consumption expenditures. And year over year, the core, which is ex food and energy, is trending towards the low 2%. That's their target range, 2%. So we got those numbers today for August. It was good and trending in the right direction. So that's good. So the market is expecting a lot of rate cuts, more than 150 basis points, 1.5% in the next year. That's a lot, but we'll see. After that, maybe the election matters the most, but definitely right now, it's the jobs data that's the number one issue.
So, Bob, is now a good time to invest in stocks?
Well, we've been talking about this for years. If you talk to the experts, it's always a good time to invest in stocks. You should not worry about things like market timing. Should I get in now? Should I wait? You have no idea what's going to happen in the stock. Believe me, you don't. Nobody does. And the best experts don't. Not wait for the elections. What people need, talk to the experts, is a plan. If you're 30 years old, you ought to have a plan for regularly investing on a regular basis, regardless of whether the market is up and down. The reason that you do have this plan is long-term, the stock market is a winner. The S&P 500 goes up 75% of the time, year over year. That means long-term, you're a winner. It doesn't mean it's up every year. Some days, some years, you're going to be down. But long-term, it's been a winner. Therefore, buy and hold is the best sensible long-term strategy because you have no idea what days are going to be better than others and what days are going to be worse. And believe me, trust me, the experts don't know either. And so all we know is the statistical and historical evidence of long-term, the stock market outperforms almost every other investment. Not every year. There are some years where bonds have outperformed, which is one reason you ought to have a diversified portfolio of stocks, bonds. I personally believe in owning your home as real estate as an asset. Real estate is an asset. Some people will debate about whether gold should be part of the portfolio, or some people will even debate whether crypto should be part of the portfolio. These are legitimate questions, but long-term, the stock market has proven to be the best overall performer.
So, Bob, you mentioned crypto. We got some questions about crypto this week. What's happening with the crypto ETFs and how are they performing?
Well, Bitcoin is in an uptrend in September, but frankly, it's been very volatile. And this is part of the problem with people who want to argue that Bitcoin is an asset class, that Bitcoin should be part of an investment portfolio. I personally think it's way too volatile, and I don't think it's proven a great use case, but some people disagree with me on that. It's flat most of this year. I think it's up 10% so far on the year. Ethereum is a little more volatile. It's up a little bit more. The good news for crypto is the Bitcoin ETFs have been very successful. They've attracted a significant amount of money. And by any standard, I would call it a success. And as I mentioned, the big issue is whether crypto as an asset class. So you think about asset classes as stocks, fixed income, bonds, real estate, cash, I consider an asset class, and commodities, particularly gold. Gold has been a use case for thousands of years. It's been used as money. It's used as jewelry. It's held by central banks. So you can make an argument that gold is an asset class. There's another group here that what you would call alts or alternative investments. This is private equity, private credit, stuff that's not publicly traded, infrastructure. Some would say crypto is an alternative investment and belongs in as an asset class. Again, this is very debatable, but certainly the industry is trying to argue now that crypto, particularly now since you can own it more safely in an ETF structure, should be part of anybody's portfolio. Again, hotly debated, but that is sort of the central issue now. It is becoming more widely accepted. I personally have always been a bull on blockchain, which I find extremely exciting technology. Blockchain simply allows for certification of ownership, essentially. You can transfer things using this, not just Bitcoin. Bitcoin was just a cryptocurrency created off of the blockchain. There's much more greater, more interesting uses for blockchain than for cryptocurrencies. But because of Bitcoin, and it all got wrapped up in this get-rich-quick scheme around Bitcoin, Bitcoin has sucked the oxygen out of the room of the discussion about blockchain. Fortunately, as blockchain technologies start to mature, this will get more important. You'll start to see settlement of stock trading, transfer of real estate, transfer of money. These are much more exciting uses than what Bitcoin actually represents. I'm very excited about blockchain. As you can see, I have some reserves about the use of Bitcoin as an asset class by itself. So overall, I'd say this is a consolidation year for Bitcoin. It was very good news that the Bitcoin ETFs were, I think, well received.
So, Bob, we're getting closer to the November election. So what do markets, how do they respond to a presidential election? And does it matter if a Democrat or a Republican wins?
The short answer is no, it doesn't. And I know people are shocked because they think somehow the president actually moves the stock market. That almost never happens. Now, when President Trump was in a few years ago, he cut the corporate tax rate. He backed legislation that cut the corporate tax rate. That did make a difference because corporations paying less tax mean potentially more profit on the bottom line. Duh. So that is one of the very few instances where a president actually made a difference. Most presidents don't. And the reason they don't is because the U.S. economy works independent of what the president wants. The economy does not run at the whim of the president. They have some levers they can pull, but frankly, the Federal Reserve is more powerful than the presidency regarding that. They control, Federal Reserve can control short-term interest rates and ultimately have an influence on money supply. So the important thing here is, why does this happen? Why does the economy act independently of the president? Because we have a system of laws in this country. We operate under a capitalist system. In a capitalist system, the means of production is primarily controlled by private individuals and corporations, not the president. They make their own decisions based on profitability and their own self-interest. This is the heart of what capitalism is. Individuals acting in their own self-interest. And when this happens, you get what Adam Smith called the invisible hand, where you have this mass of things that are happening where individuals work at their own ends. And it creates this beautiful system. The other thing that's very important in the United States is we have a court system where you can enforce contract law in an objective manner. By objective, I mean you don't have to bribe judges to get things happening in our country, generally, obviously, but you don't. And the enforcement of contracts between individuals and corporations, that sounds boring, but that's actually a critical part of the capitalist system. You make a deal with somebody, you say you're going to deliver X amount of goods to this company, and you don't deliver, you can be sued. That is a very powerful stimulus in a court and get an enforced judgment. That's a powerful stimulus for people to sign a deal and go through with it and not walk away from it. That enforces the system, the capitalist system. So as long as you have a functioning court system and a system where the means of production are controlled by individuals and corporations, this is a giant, system that sort of operates independently of the presidency. By and large, this is not always true, but by and large, they like gridlock. The capitalist system likes gridlock because nothing weird happens. So, as I said, President Trump made a difference, but that is rare. 1932, Franklin Roosevelt came in and made all sorts of changes and freed up the banking system. There's another example. But by and large, you shouldn't worry that much about who is the president necessarily.
All right, Bob, our next question. What are the best finance-related books?
Well, I talk about this. That's a whole chapter in my book about this. Those who don't know, I had a book out recently, Shut Up and Keep Talking, Lessons on Life and Liberty on the floor of the New York Stock Exchange, and you can get that on Amazon. And there's a whole chapter about how I'm going into my 35th year at CNBC, and I had to write this book about what I had learned and what I think I know. And I had to go back and look in my library because I know I drew up a list of things that I believe are true. And then I said, how do I know these are true? I've just always believed them. Well, I wasn't born with them. I had to learn them. Somebody taught them to me. And I realized back in the 1990s, when I became the stocks correspondent in the mid-1990s, that there were a small group of people that had a big influence on me. And I realized most of what I believe actually boiled down to, roughly less than a dozen books and about a dozen people that just really influenced me a lot. So number one was Jack Bogle, the founder of Vanguard. He wrote his most influential book was in 1999 called Common Sense on Mutual Funds. I read that book, and that was a whole history of why market timing doesn't work, why indexing was a better idea, why buying and selling on a daily basis is a terrible idea, why holding individual stocks is very risky. After that, I would say books on broad investing principles that echoed similar themes to Bogle. A Random Walk Down Wall Street by Burton Malkiel, professor at Princeton. There's new editions always coming out, but this goes back almost 50 years, that book. Stocks for the Long Run by Jeremy Siegel, Wharton professor, frequent CNBC contributor, a friend of mine. He looked at history of stock market investing versus bond investing going back to the 1800s. And this is where a lot of this early research comes out, that stocks are, by and large, a better long-term investment than anything, although there are periods where bonds have outperformed stocks. Winning the Loser's Game by Charles Ellis was a really important book about why you need to stay invested, why indexing investing is superior to individual stock picking. So all these books have very similar themes. And then two very broad books, both in Warren Buffett's sphere, The Essays of Warren Buffett, distillation of his best writing, and Poor Charlie's Almanac by Charlie Munger, his partner. Very folksy commentary on the stock market and how to, for example, read a financial statement. There's a new edition of that out. And of course, Charlie died about a year ago, at very advanced old age, but he was cogent and witty to the very end. So there's my short list. I think there's six books on there. All I can tell you is when I think of the stuff that I say on the air and stuff I say here, almost all of it goes back to those 6 books. There's some dim echo of all those people in my head. So those are my recommendations.
Great. Thanks, Bob. We'll definitely check those out. So our last question, we mentioned at the top that you were in Huntington Beach recently for the Future Proof Conference. So who did you talk to? What did you learn while you were there?
This was one of the most interesting conferences. Financial conferences are generally under a lot of pressure these days because attendance is a little bit spotty, and it's not because of the pandemic. People go to these, there's a buy side and a sell side. There are people like investors or investment advisors, RIAs, registered investment advisors, and they go to these conferences looking for ideas. And then there's the sell side that people want to sell them things like, State Street, Vanguard, BlackRock. They have ETF products, they have mutual funds, they have advisors who can show them how to run their businesses. So there's a buy side and a sell side, and they both want different things. So this conference, which is run partially by Barry Ritholtz and Ritholtz Capital, got 4,200 people. This is the third year. This is the biggest year yet. Half of them were RIAs. And most of these conferences are pretty boring. They're content driven. So you show up, you have breakfast, you have a speaker, then you have coffee, then you have another speaker, then you have lunch, you have another speaker, and then you have a cocktail party. Their idea here was, let's invert the trope, and let's, instead of, we'll have content, but let's have a giant social event. Let's put it on the beach. Let's have parties. Let's have not a cocktail party. Let's have a whole bunch of them. Let's have rock bands. Third Eye Blind played this year. And let's just make it a big social event. And they attracted a lot of young RIAs. You know, people are 35, 40 years old. They have 10 million in assets under management to 100 million, sometimes small, sometimes large. And then just individuals who want to have a good time. On top of that, they were able to get these speed dating procedures in where you could sign up if you were an investment advisor to meet with people on the sell side, like you want to meet with State Street or Vanguard or BlackRock, and you can sign up through a software to meet with them. And it proved to be tremendously successful. So what I find these RIAs want, these investment advisors want, I probably met with 150 of them. I said, first of all, why are you here? And they mostly said they want to network and figure out how to grow their assets under management and find the best techniques for managing money. They also want help managing their office. Just most of them, 5 to 10 people. How do I make sure we pay the taxes, manage the office? After that, they wanted help. The number one question was on AI. How is AI going to affect us? How can I use it? They are very interested in private equity and private credit. There's all this stuff out there that's not publicly traded that people can't access. Their investors want to know about that. Then there was all sorts of interest. There was some interest in crypto. There's some interest in asset allocation. Do I have gold? Do I recommend gold to certain clients? Certain clients are not comfortable with that. Those are asset allocation questions. And finally, there's questions about the economy and the Federal Reserve. So it was a really interesting conference that enabled me to sort of get a perspective from the investment community. And the sell side, the BlackRocks of the world, those guys, the Vanguards, they were really happy because they met with people who were really interested in their services. And they, as part of the software, they could click in to ask for a meeting. So if this investment advisor says, I want to meet with State Street loves that because it's a positive click in. You're not getting a cold call, in a hallway. You're asking to meet with them. So they arranged thousands of meetings through the software. And that was very interesting to watch. So what people want is a social event where they can learn a few things and network and not just be expected to sit there and listen to a speaker. We had that. There was a lot of great speakers, and I moderated some very interesting panels. So the content is there, but it's bigger than just the content. And I think that's what I liked about it.
Yeah, it sounds like a really interesting experience. I'm glad that you had a good time. Well, those are all of our questions for this week, Bob. Thank you for all of your answers. Thank you to everyone who sent in questions as always. And we'll talk again in a few weeks.
Great questions, everybody. Thank you. See you soon.